I'm waiting for the pin to drop. Good afternoon, everyone. Welcome to the meeting, the press conference after the MPC, and allow me to introduce our newest member to the MPC. On my extreme right, that's not necessarily his views, is Kuban Naidu. He has joined the bank as advisor to the governor and the member of both the MPC and the Financial Stability Committee. So this has been his first meeting, and welcome. And thank you all for joining us here today. The South African economy is facing a number of domestic challenges, while headwinds from the fragile and uneven global recovery remains a constraint to growth. The uncertain and increasingly difficult labour relations environment continues to dominate the economic landscape, contributing to declining domestic and foreign investor confidence. The growing vulnerability of the economy to changes in sentiment has been reflected in the depreciating and volatile exchange rate, which was already under pressure from the widening deficit on the current account of the balance of payments. Although inflation is forecast to remain relatively contained, these factors have raised the upside risks to the outlook at a time of worsening real growth prospects. The year-on-year inflation rate as measured by the Consumer Price Index for all urban areas was 5.9% in April 2013, unchanged from the previous 2 months. However, the drivers of the overall rate changed somewhat. Food price inflation measured 6.3% in April, reversing the downward trend that had prevailed since November 2012. The contribution of food to overall inflation remained unchanged at 0.9 percentage points, while housing and utilities contributed 1.4 percentage points. Administered prices increased by 8.9% and by 7.8% excluding petrol. Core inflation, which excludes food, petrol and electricity, measured 5.2%, marginally up from the 5.1% in March. The headline producer price inflation for final manufactured goods measured 5.7% in March, up from 5.4% in February. The inflation forecast of the bank was relatively unchanged since the previous meeting of the MPC. Inflation is now expected to average 0.1 percentage points lower in 2013 and 2014 at 5.8% and 5.2% respectively, and to average 5% in 2015. A temporary breach of the upper end of the target range is still expected in the third quarter of 2013, but at a lower average level of 6.1% from 6.3% previously, followed by a gradual moderation of inflation to 4.9% in the final quarter of 2015. The slight improvement is due to changed assumptions about international commodity prices, including oil, and lower global inflation. The forecast for core inflation for 2013, at an average of 5.3%, is significantly higher than the forecast of 4.8% previously. This follows the sharp increase in medical insurance costs in the February CPI. Core inflation is also expected to be adversely affected over the coming months by increases in a number of other administered prices, particularly water and municipal rates and taxes. This measure is expected to peak at 5.4% in both the third and fourth quarter of 2013 and to average 5% and 4.6% in the coming 2 years. Despite the higher near-term trend, this indicator is still assessed to reflect an absence of significant demand pressures. Inflation expectations, as reflected in the Reuters survey of analysts conducted in April, has remained relatively stable for some months. The forecast is the same as the bank's for 2013, although higher for the next 2 years, but still within the target range. The relatively anchored inflation expectations at the upper end of the target range are also evident in the survey conducted by the Bureau for Economic Research in the first quarter of 2013. Overall, respondents expect inflation to average 6% in both 2013 and 2014 and 6.1% in 2015. The global economic environment remains challenging, with different regions growing at varying rates. Within the advanced economies, the United States appears to be showing a number of positive signs of recovery. The University of Michigan's Consumer Confidence Index is at its highest in almost 6 years, Labour market developments have been more favourable, and there are strong wealth effects from the booming equity market as well as from the recovering housing market. However, headwinds can be expected from the fiscal contraction resulting from the fiscal cliff compromise and the spending cuts that were part of the recent sequester. The impact of this contraction is expected to be as high as 2 percentage points of GDP. The Eurozone remains in recession, having contracted at an annualized rate of 0.9% in the first quarter of 2013, compared with a contraction of 2.7% in the previous quarter. The French economy has recorded two consecutive quarters of negative growth, while Germany managed to avoid recession by recording annualized growth of 0.3% in the first quarter of this year. The Eurozone is constrained by continued deleveraging by households, banks and governments, and the region is also characterized by increasing financial fragmentation. Although a slower pace of fiscal consolidation in the periphery has been agreed to in terms of the bailout agreements, negative or at best very low growth is expected to persist in the region for some time. The Japanese economy rebounded from its 2012 recession in the first quarter of 2013, but it is still too soon to assess the impact of the fiscal, monetary and structural policy stimulus packages that were announced recently. The yen exchange rate, which has depreciated by around 30% against the US dollar since October 2012, is likely to contribute positively to growth. Emerging markets remain the main global source of growth, but there are signs of moderation in some of the systemically important countries, particularly China, India and Brazil. The rebalancing of the Chinese economy away from fixed capital formation and production towards internal consumption has resulted in some slowdown, which has contributed to the declining trend of global commodity prices. The persistence of slow global growth and weaker commodity prices have resulted in a moderation in global inflation. This is particularly the case with respect to energy prices in the advanced economies. This combination of lower inflation and slow growth prompted further monetary easing by the ECB, and with Japan yet to begin its quantitative monetary easing, these accommodative policy stances are likely to persist for some time. While there are concerns about the possible risks posed to financial markets and global capital flows by an early reversal of the US monetary policy stance, any such action is likely to be extremely cautious and is only expected to begin once a sustained recovery is well entrenched. There are, however, growing concerns that the buoyant conditions in the financial markets in many countries are indicative of bubbles caused by excessive global liquidity, rather than reflecting underlying positive growth prospects. Movements in the exchange rate of the rand continue to be impacted by external developments, but since mid-2012, these have been compounded by domestic factors which have undermined investor sentiment. The increasingly fraught labour relations environment and high wage demands in the mining sector in particular are likely to continue to impact adversely on the volume of mining exports against a backdrop of falling international commodity prices and concerns about the widening of the current account deficit of the balance of payments. These developments also have the potential to affect, directly and indirectly, South Africa's credit ratings and increase the cost of much-needed finance. The rand has also been influenced in recent weeks by the hedging related to renewable energy projects, as well as a strengthening of the dollar. Since the previous meeting of the MPC, the rand has depreciated by around 4.6% against the US dollar and by 3.7% on a trade-weighted basis. Despite the current negative sentiment towards the rand, non-residents have remained net buyers of bonds and equities this year. Since January, non-residents have been net buyers of equities to the value of 12.7 billion rand and bonds to the value of 22.5 billion. However, these positive inflows can reverse very quickly in response to changing risk perceptions. Furthermore, any hedging of these exposures, as is sometimes the case during periods of rand weakness, puts pressure on the rand even though the underlying assets are still held by non-residents. As we have noted previously, the impact of the weaker rand on inflation is dependent on the extent, speed and duration of the depreciation, as well as the phase of the business cycle. While some of the recent decline reflects changes in underlying fundamentals, the rand remains highly vulnerable to changes in sentiment. The rand has a tendency to overshoot in either direction, and at times for extended but uncertain periods, making the impact on inflation difficult to forecast. The current level of the exchange rate, if sustained, poses a significant upside risk to the inflation outlook. Domestic growth prospects remain fragile amid low consumer confidence, continued output disruptions in the mining sector, electricity supply constraints, and a weak global environment. The growth forecast for the bank has been revised down from 2.7% to 2.4% for 2013 and from 3.7% to 3.5% in 2013 and 2014. Growth is expected to accelerate to 3.8% in 2015. At these growth rates, the negative output gap will widen further before stabilizing next year and begin to close during 2015. This outlook is consistent with the flat trajectory of the bank's leading indicator of economic activity. Notwithstanding the increase in the RMB-BR Business Confidence Index in the first quarter of 2013, given the difficult labor relations environment in the country and the risks to global growth, the downside risk to growth remain, as does the possibility of increased job losses. Although the physical volume of mining production recorded a quarter-to-quarter increase of 6.1% in the first quarter of 2013, following the disruptions in the previous quarter, output contracted on a month-to-month basis in both February and March. The outlook for the sector remains bleak, with threats of shaft closures and retrenchments, falling commodity prices, high wage demands, and a risk of protracted periods of industrial action and further supply disruptions. Manufacturing production declined in the first quarter of 2013 compared with the previous quarter, although the extent of the decline is complicated by the seasonal adjustments for the Easter weekend, which fell over March and April. The Kagiso PMI, which increased marginally above the neutral 50 level in April, reflects the uncertain outlook for the sector. The depreciated value of the rand should improve the competitiveness of the sector, provided that gains are not eroded by rising wages and prices. The weaker rand is expected to result in some narrowing of the trade deficit. However, the subdued global demand, together with robust import volume growth driven to a large extent by infrastructure projects, suggests that the net export position will remain negative over the forecast period and continue to be a constraint on growth. Nevertheless, the BR Manufacturing Confidence Index, while still low, improved somewhat in the first quarter. The outlook for household consumption expenditure, in recent years the main driver of growth, appears to have weakened, with the FNB-BR Consumer Confidence Index declining to a 9-year low in the first quarter of 2013. Retail sales grew at a modest quarter-to-quarter rate of 0.6% in the first quarter of this year, while sales contracted on a month-to-month basis in March. This was consistent with a decline in the BR Retail Confidence Index in the first quarter. New vehicle sales growth, while increasing significantly on a year-on-year basis, moderated to 0.1% on a 3-month-to-3-month basis in April. Consumption expenditure by households is expected to be constrained in part by lower real income growth, significant increases in the price of electricity and petrol, and high debt levels. The slowdown in expenditure growth has also been related to the moderation in some categories of credit extension by banks. Year-on-year growth in total loans and advances to the private sector moderated steadily from a recent peak of 10% in December to 8.1% in March 2013. Excluding the weak growth in mortgage advances, year-on-year growth in loans and advances declined from 18.5% in December 2012 to 14.5% in March. Although growth in unsecured lending to household remains at high levels, it has declined continuously since September 2012 to measure 27.9% in March. This moderating trend is expected to continue, due in part to the increasing number of impaired advances in this category of lending at some of the banks. However, the ratio of total impaired advances to total loans and advances in the banking sector continues to decline and stands at just below 4%. A number of sectors in the economy are entering into wage bargaining rounds. The MPC is increasingly concerned about the prospect of settlements well above inflation and productivity growth, and the risk of protracted and disruptive strike action, with negative implications for growth and exports. Furthermore, excessively high settlements will come at the expense of retention of employees, employment creation, and could result in higher inflation. The risk of a wage price spiral remains high. This would negate the benefit of wage increases to workers and undermine the competitive gains of the currency depreciation. According to Andrew Levy Employment Publications, the overall wage settlement rate in collective bargaining agreements increased from 7.6% in 2012 to 7.9% in the first quarter of 2013. Should this upward momentum continue, it is likely to impart an upside risk to inflation. At a time of high and rising unemployment and slowing growth, the imperative of an economy-wide commitment to wage and salary restraint at all levels, including executive pay, cannot be overemphasized. International oil prices are expected to remain constrained by the subdued global growth environment, but vulnerable to political developments in the Middle East in particular. Having reached a recent high of around $118 per barrel in mid-February of this year, Brent crude oil prices have remained in a range between $97 and $105 per barrel since April. The domestic price of petrol increased by 12 cents in April, but declined by 73 cents in May, mainly as a result of lower international oil prices. Although there is currently a small average over-recovery on the petrol price, recent exchange rate movements have raised the probability of further petrol price increases in the near term. The higher CPI food price increases in April may have reversed the favorable food price developments observed in recent months. Since the end of November 2012 to date, domestic maize prices have declined by about 17% and wheat prices by around 9%. This is reflected in the Producer Price Index for Agriculture, which increased at a year-on-year rate of 1.4% in February and declined by 0.2% in March. Manufactured food prices, by contrast, increased by 6.1% and 6.3% in the same months respectively, in line with CPI food price increases. The exchange rate poses an upside risk to food inflation as prices of agricultural commodities such as wheat and maize are based on international prices. The MPC is increasingly concerned about the deteriorating outlook for the South African economy. There are a number of critical domestic issues that are contributing to the vulnerability of the economy that need to be urgently addressed. These include the financing of the deficit on the current account of the balance of payments, the fractious labour relations environment and the associated risks of protracted work stoppages and excessive wage increases, electricity supply constraints, upside risks to inflation, downside risks to growth and employment creation in a context of high unemployment, and declining domestic and foreign investor confidence, which could impact directly on capital flows. These interrelated developments are reflected in the volatility and weakness in the exchange rate. There is an urgent imperative for all parties, government, business, labour and civil society, to interact and address these issues and vulnerabilities at a national level. While the bank is prepared to play its part, many of these challenges are beyond the role, scope and effectiveness of monetary policy. While a depreciated exchange rate is part of the balance of payments adjustment mechanism, the competitive advantages thereof need to be realized through price and wage restraint. In the absence of such restraint, the outcome is simply higher inflation with the risk of an exchange rate inflation spiral. Given the current unsettled environment in the economy, the MPC assesses the risks to inflation to be on the upside, while many of the above factors contribute to a downside risk to growth. The MPC assesses the current stance of monetary policy to be accommodative. Given the risks outlined above, the scope for further monetary easing is limited at this stage. The MPC has therefore decided to leave the repo rate unchanged at 5% per annum. The MPC stands ready to act appropriately in either direction in the event of material changes in the outlook. Thank you. It's the end of the statement, and I can see many hands straight away. Please, colleagues, just remember that you will also be answering questions. So if we could perhaps start with you, Mariam.
Thank you, Governor. Are you concerned at the current level of the rand, and do you think that it is undervalued at present?
I think that question would be better able to be answered if we knew at what moment in time you were talking about in the day. Generally, because what we are seeing is the rand moves very significantly. And as we've said before, we do not target a level of the exchange rate. But as I've said, I think I have elaborated in the statement quite considerably that it depends how long it is out for, how long the depreciation lasts, what extent it is, what is the sustained levels, and what its impact would be in that regard. We're also saying that at these levels, there is the question of using a depreciated currency to improve competitiveness and make sure that if there is a depreciation, it is maintained and not eroded by either inflation or either wage demands or price hikes. So I think we have spelt it out quite considerably in the statement. Renee.
Good afternoon, Governor. It's Renee Volgraaf from Sunday Times. Governor, I want to know, in the bank's improved inflation outlook, was the recent risks of the rand taken into account, and also the risks of possible above-inflation wage settlements that you referred to?
I'm going to ask my colleagues to respond. Who would like to take? Brian?
In the latest forecast round, we did assume some further depreciation of the exchange rate, not necessarily to the current levels, but we are cognizant of the risks to that. So a lot depends, as the Governor said, on whether it remains at these current levels or if it comes back. But there is a weaker exchange rate assumed, but clearly the fact that the outlook or the forecast didn't change very much means that it was offset by other factors, including lower commodity prices. But certainly we see the overall upside risk to the inflation outlook coming primarily from the possibility that the exchange rate could remain at these very depreciated levels.
France?
And the wage settlements?
Sorry, the wage settlements are the other main risk, that upside risk that we see to the inflation outlook. We are concerned about the level of some of the wage, the first round of these wage demands that have been put forward. But as we know, they don't always turn out to be at those levels. These are simply the first round of the wage bargaining. But in addition, we know that in the past that wage increases are not necessarily automatically translated into price increases. That would depend on the pricing power at the time. And also depend to what extent employers simply focus on the wage bill, and therefore you see some reaction in terms of the amount of employment.
But I think just in addition to that, it's got to also reflect the levels of productivity. So it's not just the absolute levels of what you eventually settle at. It also can be, the level is not as important if you're getting the component of productivity that would then address some of the issues there. So it's not absolute levels only, it's also what happens with productivity. Frans?
Governor, Franz Wild from Bloomberg. You say the rand has a tendency to overshoot. In this instance, just talking about this morning, for example, where it nearly reached 9.7 to the dollar, is it your assessment that it has overshot and will come back, or it's hard to tell?
I'm going to ask Daniel to deal with that, but don't forget also what you're dealing with at the moment is dollar strength, so it's not just a rand factor. But Daniel?
Yeah, I think, as we've indicated in the statement, when there are changes to the fundamental backdrop, it is normal for the currency to adjust. The key concerns would only arise if those adjustments happen in a disorderly manner or very abrupt and in very sharp moves. And that is not just limited to the rand. It happens with all free-floating currencies that as and when there's a change in the underlying fundamentals, to try and find a new level does tend to be associated with over and undershoots and all that. It's difficult to sort of pin them down to a particular level and say if the rand this morning in reaction to the news overnight, be it out of the US or the issues associated with Chinese data that resulted in different risk perceptions, you can't sort of put it at a level, say at the level of whatever 969 or 68. That is actually then when the point of overshoot is reached or not. So it's difficult to pin it onto a particular level. So I couldn't tell you whether this morning was an overshoot.
Yes.
All right, the Q&A session there at the Reserve Bank. Governor Joan Marcus announcing that the repo rate will stay steady at 5%. That's the decision that came out of the Reserve Bank this afternoon. We'll get some analysis after the break. Do stay with us.
I'm going to tell the truth.
The bet is going to be a free man.
So that means he can still come after us.
Keep it real, boys and girls.
Aren't you a little young to be a lawyer?
Tom?
Yes, but hopefully not for long.
Well, exactly how dirty does he intend to get?
Dynamite.
Nothing come cheap.
Sabotage?
I can put in some security arrangements, make sure there's no accident.
This deal is done, and there will be no accident.
Isidingo, Monday to Friday at 7:30 on 3.
Stand a chance to win 2,500 Rand by answering this question. What new bank account has Lorato open? SMS Isidingo and ABOC from the on-screen options to 45640. T's and C's apply. Go to www.isidingo.co.za.
Epstein, I think I found something.
10-4 will be right there. Epstein, what's your 20?
Oh.
You in a court of law.
Hou hom uit die casino en weg van my gesin.
Well, you said you wanted action.
Are you sure you can handle something like this right now?
Welcome back. Good afternoon once again. You're watching a special broadcast on the repo rate decision by the Reserve Bank. Governor Jill Marcus announcing just a short while ago that the repo rate will stay steady at 5%. So what does that mean? Well, it means that no increases or decreases on interest rate for consumers. But let's get more analysis on that actual decision. With me, Tendandi Machimuli, consumer economist at Liberty. Also joining us, Russell Lamberti from Econometrics. Russell, let's start with you. All right, it's all about high inflation, sluggish growth, a weakening rand, basically sums up what you spoke about. How would you characterize the governor's tone this afternoon?
Yes, it's a great question. We were chatting off air about it. It's very much one of tightrope walking. It's kind of a very balanced, perhaps even slightly confused statement. I think she's weighing up all kinds of risks. As you said, there's a weak rand, which would tend to suggest rate hikes. There's very soft growth. We're going into a very soft cyclical growth patch now, so that would tend to suggest rate cuts. And clearly right now the sort of simplest and easiest decision for them to make is to keep rates on hold. It was widely expected in the market, nothing too untoward there. But definitely the sense coming out that there's a lot of confusion. It's a very uncertain world. Lots of pressures that they're trying to balance at the moment. And to some extent, I think the Reserve Bank has possibly missed its opportunity to perhaps move on rates. Our view at ETM Analytics is that the central bank should have been hiking rates a lot sooner already, because we've already started getting into this unsecured lending situation now, which is starting to look a bit wobbly. But overall, given where they're at the moment, you kind of feel that there was very little else she could do.
Tendani, what do you feel about that? Could that have been the move to hike rates? I mean, we are looking at a rand that's weakening, quite concerning. And, of course, you have that inflation risks from there as well.
If you were solely looking at the rand and trying to protect the value of the rand, that's the route you should have gone, hike interest rates. She did mention the fact that one of the reasons why they had to balance out growth and the weakness of the rand was that you do need to attract investors, capital flows into the country to help finance the current account deficit. So with the rand being this week, theoretically we should have seen the current account balance improve with exports increasing, but you only export what you have produced, and you can only export if there are buyers on the other side. She did mention the fact that Europe is still on recession, and that's one of our major trading partners. So you can't say you're going to have a volumes of exports increasing to reduce the deficit. And coming back to the rand itself, the weakness in the rand is not something that the bank can defend just by hiking interest rate. She mentioned some concerns which are causing a perception of South Africa being more risky. So if you are investing in a risky environment, you need interest rate to increase, which is where Russell mentioned the fact that looking at the rand only, you should have a hiked interest rate. But even if the bank could hike rates for now, the perception of labor unrest getting out of control will still continue. And that's not the ambit of the Reserve Bank, that they can go on their own and say, please don't put up unduly high wage demands. So it's government, it's labor, it's the private sector which also have to come to the party to defend these very, very worrying weaknesses in the economy.
Russell, how has ETM been looking at what's been happening with wage negotiations, with the labour unrest? Let's face it, she spent a lot of time talking about the increasing concern, as she puts it, on what's happening on the labour front at the moment. What's your take on what she said?
Well, I mean, we consider the whole area of labour unrest a major concern for this economy. But we've also got to dig in a little deeper as to why we're seeing such strong wage increases coming through. And one of the big reasons is because the cost of living is accelerating away from particularly the poorest communities. This is as a result of, in my view, excessively low interest rates, a credit-fueled consumption binge that manifests in more debt, more people going into debt. That raises the money supply, it raises the liquidity in the system. You get price increases coming through. The currency weakens. Now we're importing oil at so many more rand than we used to be. The petrol price alone is a major factor on people. These are the things that are driving the wage demand. So, the Reserve Bank tries to paint the picture as though they're completely separate from that realm. But, it's all endogenously linked. It's all linked to one another. This is a system that's very complex. And when the Reserve Bank holds rates low like they are, there's some benefits that they perceive, but there's a lot of costs that you pay for that as well. And I think one of those costs we're starting to pay is what's coming through on wage demands and labour unrest. And quite honestly, the weaker the rand gets, the longer we prolong this low interest rate environment. And let's face it, it's a very low interest rate environment for South Africa's standards. The more labour unrest I think we're going to see. Very, very sort of negative for this economy and for the investment outlook as well.
I want to still stay with the rand. I mean, there was a concern, increasing concern by some sectors saying, well, it might be good for us, let's keep the rand at this level. If it's at this level, we can start selling and perhaps get some activity in the sectors. But, I mean, it's been going on this trend for some time. You haven't really seen sectors being helped out here. And I think, as the governor puts it, on the other side, demand's low. No one's buying Tendani, is it?
So the rand has depreciated about 14% since the beginning of the year. So the theory that most exporters had, that if the rand depreciates beyond what some consider fair value at 8.50, then it's going to be easier for exporters. So if those who exported and have repatriated this week benefited a lot, you would have seen some shares going up primarily because of that. So that was good news for those people. The problem with the weaker rand for the general populace is that you get a lot of imported inflation. One of the items that went up significantly yesterday was the food component. Global food prices are showing a trend of moderating. However, if the rand remains at this weak levels, you're not going to see that coming through to food prices in South Africa because you're going to import at a higher cost. So that filters through to the part of the population whose in the component of inflation, they spend more on food, they spend more on transport. You have heard about the commodity prices moderating. We're not going to reap the benefit of that with the weaker rand as it is. Oil prices are included in the moderation of those prices. However, the over-recovery that we have seen is coming down each day because of the rand weakness. So you're not going to reap a full benefit of the rand. The exporters themselves, it's not only the rand which will make you competitive, it's the productivity of the labor component of your output which is going to make you more competitive. I don't think when we look at wage negotiations, we link it to productivity. And that is, I think, where we also miss the boat. It's not only the rand that will make you competitive, it's also your productivity.
That's on the domestic scene. Russell, she's also spoken at length. It's what's happening overseas. The EU, she says, still expecting negative, if not very little growth. That's a concern, isn't it?
It's a major concern. I mean, overseas, by and large, is a mess, particularly Europe. They're working through they're working through a lot of challenges, but even the United States, that appears on the surface at the moment to be a little bit more buoyant. When you really look at their structural issues, they're still a debt-addicted economy. The UK is still a debt-addicted economy, so is Australia. China's becoming that way. So we're not really solving the debt crisis, are we, overseas? It's kind of, we're just going into more debt to try and fix this problem. And that's, the chickens are coming home to roost domestically in South Africa. Where are our export markets? Europe, very difficult. Even China, which is an emerging export market for us, is coming under huge pressure. Now we're going to start looking towards Africa. But to a large extent, Africa has been benefiting from what China's been doing in Africa. And if China starts slowing down, so the interconnectedness here is significant. And I just think, to Tendani's point, that this notion that a weaker rand is attractive for this economy. I mean, I think we really just must reject this view, because we must also remember that we import a lot of critical goods for this economy. We don't make everything here. And so, one's got to find a stable, balanced level for the currency, and we've got to work through our structural imbalances, like the current account deficit. That's driven by excessive debt spending and so on, all which I believe can be remedied by higher interest rates. But the Reserve Bank's not in that same sort of thinking at the moment.
When should that happen?
Well, in my view, we should have already been hiking, and we can start hiking now. It will entail taking some short-term pain. When you start hiking rates like that, you, in a way, precipitate a mini recession of sorts. You cause unprofitable, marginal sectors and businesses to be liquidated. You clear out a bit of the mess, and you restart off a sounder footing, but it does require taking some pain.
I'll put the same question to you, Tendani. When should we see movement, in your opinion, on the repo rate?
We're not expecting any change in interest rates for the moment, unless there's a significant deterioration in growth, and at which point I think the bank would hike. While their primary mandate, which they should focus on, is price stability, I do think they have some pressures coming from the social side to make sure that growth continues. I just don't think there's political will in the bank to hike rates now and have a larger portion of the population lose whatever jobs we have. So for us, if there's a change towards the end of the year, depending on the growth, where it goes, it might not be a hike, it will be a cut.
All right, let's leave it there. Tendani Machimoli, consumer economist at Liberty, thanks very much indeed for your time. And let me get this right this time. Russell Lamberti from ETM, thanks indeed for talking to us.
Good to be here.
Thank you.
Well, that's where we leave it. That was a special broadcast on the Reserve Bank's decision, the repo rate staying steady at 5%. Bye for now.
Thank you.
I have to go.
Heartburn.